Good morning. All right, Rhino, good morning, good morning, good morning. Let's see what we got going on today. Let's let everyone get in. Totally cool. I wanted to thank Don for the interview last week. All of his content is always really amazing, and it's always a privilege to be on his, happy Monday, Don. It's always a privilege to be on his platform, and when we see what he writes about us, it's always honest but flattering. So it's nice to know we do a good job and it's seen by those, right? So that's pretty cool. So thank you, Don. All right. Let's see. Let's get everybody in here. We have a very good showing to start. And like we always say, oh my God, there's like 500 people in here. I don't know what to do. There's not 500, but how far off are we, right? So that's actually kind of something for another day, right? Like when Anthony says 500, how much is he lying by? Is there really like 450 or is there really 3? You don't know, which is a good thing. I don't think anybody ever wants to be the only one, but nobody ever wants to be lost in the shuffle. So if somebody could believe, hey, listen, I'm part of a good group, and at the same time, believe that it's a really good group, but believe that they're the only ones in the room, I think we hit the mark. Boom. Hey, Frida, hello, or good morning to Israel, which is probably in the afternoon by now. Cool. We have a nice starting group. So I think we'll get into some stuff, right? Hey, Mike is in the house. How cool. And I think if I got the times correctly, Mike is driving or picking up his kids from school, because in Sweden, it's a different time, obviously. So we're somewhere over there in Mike's life, which is totally cool. All right. So let's just kind of get into some stuff. Let's see where we left off. I think we're going to be doing charting a little bit more today, because I don't actually have a strong enough view of where we're going. I actually have to do my own research. And by doing my own research, it means we just do it together, right? So in any, my boy welcome himself home today. So, oh my God, welcome. And it is 5 in the afternoon in Israel now. Cool. I love being global, right? Like we have fingerprints all over the place, and that's amazing. So as it pertains to the market, we do not have enough to have a strong view, right? So I believe we have a pretty strong macro view. Like we have a good sense of what the bigger picture is, but in terms of trading, one of the skill sets that we've learned through our lives and our time is do not feel pressured, or not feel pressure, because I think we always feel the pressure, but do not feel obligated to make a trade because that's called gambling, right? If you go ahead and say, I'm going to make this trade because I haven't made a trade in days, it's called gambling. In fact, the ledger that I sent out to everyone has access to at any given point, which is every trade that we do. And again, we do it right in front of you, right? Okay, we're going to do this trade, screen share. So I say that because it's so super impressive that it's easy for one to say that hasn't been a part of this platform before, like, oh, anybody can make a sheet up. No, that's actually done in real time. And if you take a look at that sheet, you'll see that there are spans of 2 weeks where a trade's not done. In fact, I believe you'll see one at the beginning of January. And the reason I say that is because that's actually the reason we started RHINO Wealth in terms of making it a day-to-day boot camp. This platform was a Monday call. But because we want to go ahead and welcome as many new eyeballs as possible to RHINO, and we use the vehicle of RHINO Wealth because some people like, and I don't know really what you're doing over there. Sounds cool, maybe one day. Oh, you guys are doing stock stuff? I do that. All right, I guess I'll check you out since I'm in the store already looking at your stock shelf, right? Maybe I'll check you out since I'm already in the store looking at your bubble gum, right? So it's a very, very honest approach. It's distributive marketing. We are marketing to everyone, but we're finding ways to distribute you value so that you say, oh my God, I love this. All right, let me go ahead and take a look further, because they're really going out of their way to do everything, right? It's like you're the pretty girl and we're sending you flowers. We're asking you to go out for coffee. We're sending you a CD to your favorite band. Eventually you're like, all right, I've never been so loved. No one has ever done this level of extent to win me over. I guess I'll go see them for coffee. That's what we want. We want you to come see us for coffee. So the point of the story is, when January rolled around and we had 2 weeks that we didn't make a trade, it wasn't that we were like sleeping at the wheel. We just did not see a trade possible. We saw that the market was coming in, and we did not feel compelled to get in front of that for any reason. There is no nobility. You are not cool because you lost money, just so you can be in a conversation with other people who lost money. You know who the cool person is in that conversation? The person that made money. You know how I know that? Because the person that made money has nicer things. The person that made money is in a better mood. Therefore, I just kind of think they're the cooler person, right? That being said, in the middle of January, we saw our exhaustion indicators, which we share with everyone, our RHINO indicators. They were getting to levels that were catching our attention. So we said to ourselves, this could be a really great opportunity, because now we want to go ahead and make a trade, and we believe the risk reward is very much in our favor because things are so exhausted. They are measuring 99 on our meters. In fact, I am so confident that we can make 40% on a trade that I think I'm going to stick my neck out there, scream from the rooftop to the entire world, hey, come look at me. I'm going to do it right in front of you. And we did. In fact, if you remember that first week, we made 40% on Netflix overnight between Wednesday to Thursday of that week. And we sat to ourselves and we said, okay, now what do we do? That was a kind of anticlimactic. It was so easy to make that 40%. It was almost like we found the money in our pants pocket, right? Like, you want to have a bit of a struggle to make the money so that you know you made it, you were there, you felt it, you like, if somebody just gives you $1 million, you're like, okay, I'm $1 million richer, but like, your life didn't change. You didn't do anything to earn that million. It's not like you agonized every day working 9 to 5 and then 6 to 10 saying, when I get that million, I'm going to go ahead and build a restaurant. I'm going to send my kid to college, whatever the case may be, whatever your goals are. It's the labor, it's the duration, it's the time you spend doing it that allows you to feel so compelled to that goal, that when you hit that goal, you achieve that goal and you reward yourself with that goal. But when you have the money given to you so quickly, you're like, I mean, I guess I'll go for sushi today, right? Like, I could eat a good lunch. So we said to ourselves, you know what? Let's do it another week. Let's do one more. And then we ran into Apple. And we thought Apple earnings were going to be great. And they were, right? But our belief was, and again, so we like sharing the good and the bad. One of the strategies that we've always found to be quite reliable is during the earnings season. Now, earnings season is once a quarter, so 4 times a year. Companies come out and they share their earnings. They open their books and say, this is how we're doing. So it goes ahead and it separates the people that believe things to be good and were wrong, or people that believe things were bad and wrong, and vice versa, people that believe things were good and were corrected, whatever, right? But so you see the stocks have volatility because it's the truth day. All right, show me what you got. And a lot of times, a company will say, okay, and they're in line, right? People think they're going to do $10. They did $10.50. Everyone's happy. But every now and then you have a company that people believe are going to do $10 that did $30, and the stock flies. And you have a company that people believe are going to do $10 and it does $2, and the stock tanks. It's these companies that do that regularly that become your companies known as Apple and Facebook and Google. They could not have been that big if they didn't constantly beat earnings all the time. They could not be that notable if they constantly didn't surprise people to the upside. With that said, companies and investors have muscle memory. Oh man, I've been making money on Facebook for years. In fact, every time Facebook reports, I make money. So when Facebook's about to report, I buy Facebook stock because, hey, it's going to do well. It's Facebook. You hear that very commonly. I've heard that with Apple for 14 years now. So, and Apple's the largest company in the world. So I feel very comfortable to say, okay, the market came down. Apple reports next week. There's going to be a certain muscle memory during that week that's going to allow me to buy options that expire that Friday. Like, these things expire in a week. If I don't get my target, they go to zero. But because so many people have been conditioned to believe that those are going to go up, I have a floor. These things aren't going to go zero. They might go down 50 or 60% worst case scenario. Anthony, 60% is really bad. Well, we're playing at a different table, right? We're not buying stock. We're not putting hundreds of thousands of dollars of our retirement funds in stock that we expect to grow over the long term. We are trading, right? And the difference between gambling and trading is that you have rules that you live by. You have rules that you've set up, and you have paradigms. Like, this is the worst we can do. This is the best we can do, and you stay within them and you stay disciplined. So with Apple, we said, okay, let's go buy those calls. And we bought them a day too early. And one day too early led to a 60% loss in that position, which actually, if we held it to expiration, would have been 100% gain. Because if you remember, Apple did really, really well and went up to like 176 the next day. Our options were for 165. So we would have done fine. That being said, that position was down 80% at one point. Actually, that position started up 20%, down 80%. We got out at 60% and ended up being plus 100%. How about that roller coaster? Well, Ant, that doesn't sound good. No, it wasn't. But what did we do? Did we ever put all of our money in that one position? No, we put the other half in buying Apple the next day. That position went up 50% overnight. And then the position that we sold in Apple down 60%, we put into Etsy and made 60% overnight. So all things being considered, our portfolio is higher than where it started. And along the way, we've made 40% profits ever still. In fact, since we started this platform, or not the platform, but since we started doing daily calls since the middle of January, we've done, I think, 5 trades. 4 of them have been profitable. 3 of them, 40% or over. In fact, we have people in this platform that made $42,500 overnight, which was close to 300% on their money overnight. Because the example of Facebook was one that shows the other scenario of what could happen. Yeah, Facebook, it's going to be great. Facebook lost $260 billion as a market cap, as a company, the day after earnings. It was the single biggest stock loss ever in the history of the market. And like, we haven't seen it in a while, but ever is a long time. So are we so smart that we were able to take a short position in front of the biggest loss ever in the history of the stock market? No. It's like, what's the saying? Luck is the residue of hard work, right? Something like that. If you just continually to work hard, you're going to put yourself in a position that you're going to have these big wins. And when you do all the hard work, you can put yourself in a position that you can sit here from my perspective and say, I lost 60% on a trade right in front of you and still have an account that's up 50%, still has shown every other trade, not every other trade, one other, but all the other trades to be profitable. So in any world, if anyone said, hey, listen, I lost 60% in front of people, wow, everyone probably hates you. No, because we are able to show things good, we are able to show things bad, and we're able to reach our goal because we have a system. In fact, we made money buying things to go up, and we made money buying things to go down in the same market. So is that by coincidence? Is that by design, right? So all of this sharing is because we have many new people that we have not had, because we had the good fortune to meet Mr. Don Sturgill. Now, does that mean that we were lucky? Maybe. He's fantastic. But because we've done so well, and because we've grabbed the imagination, the attention of others, it was in his best interest, not best interest, but in his design to say, you know what, I'd like to share this with other people as well. I stand behind RHINO, and those that believe in me, I would like to recommend this. So we have so many new people today. And the point is that luck? No, we just work really hard, and others that see it like to be a part of it. And that's super cool. So the reason I say all this is because right now, I don't know where the market is. And we're going to look. And for those that are new, I always say that because I never know where the market is at 10:13. Because our belief is from 9:30 to 10:30, it's called rookie hour. And that's not a derogatory term, but think, especially on a Monday, think about all the people that are very, very emotional. Oh, I lost money last week. I made money. Oh my God. When that market opens up Monday, I'm ready. I'm ready. Wait till that market opens. It is those people that we love taking advantage of. It's like if you've ever been in a bar fight, which we haven't, but we've seen them on TV, and you always have like that one sober guy whose father was like, what was his name? The guy from Karate Kid. Anyway, the grandfather. It's always one of those that like has been taught by a sensei, and he doesn't drink. And then there's the other one that's this big muscle head jock, and he comes in and I'm gonna get you. And the Karate Kid's just like, whoosh, whoosh, boom, right? Or doesn't even punch him, just kind of pushes him out of the way, and the guy falls. That's what 9:30 to 10:30 is in the stock market. It is all those people, the big jockey people that drank a lot, that have the really, really pretty girl over there who is like a cheerleader who's going to end up having like 7 kids in like 2 years and drop out of college. And that's a bad, whatever. It's the movies, right? And they think they're so cool, but they didn't realize that the education is what makes someone cool. It's the education, it's the discipline. It's not the who looks cool. It's not the machismo. And that's the participants in the market in the first hour. They're just flailing around. So what we do is say, Guys, we're not even interested in what you're doing. We don't even care. Let you do what you want. At 10:30, we'll step in when either you got lucky because you're right, or you really, really are upset that you were wrong and now you're selling things, and that's where our opportunity comes in. So as a rule of thumb, we don't actually buy anything until at least 10:30. So I don't really need to know where the market is, because when we're talking, I don't need to be biased either, right? And it's not that I would try to be biased. It's just human nature. If I'm talking to you and I see a market that's up 200 points, maybe my next sentence is something of the effect of, and I don't know where the market is, but I just have this feeling that it's going to be up today. And I have that feeling because I've worked so hard at this and my experience tells me it's going to be up. Oh my God, look at it's up. And that's unfair to you, right? You should not be listening to someone who has anything up their sleeves. I don't know where anything is, but I know that we're going to find out together. I know that when I look at it, you're going to see my face and be like, whoa, he was stunned. How many times have we done something where I'm like, I don't know. Oh my God, it's down 600. And we're like, okay, cool, let's regroup and let's see what we do in that position. Now, we talked about the macro, so let's talk about that. From my perspective, like I said, since the beginning of January, when you are a professional money manager, which I was in a past life, you need to know the macro. It's not the micro. You need to know if the circus is coming to town, because if the circus is coming to town, you could be a peanut vendor and you would have a hard time not making money. So you want to go ahead and put your money in a situation where the liquidity is there, where the money flows there. Because then even if you're wrong, you never get hurt because there's so much money everywhere. Do you remember in 2020 when we were having these talks together? In 2021, we were having these talks together and we said, no, the circus is in town. They are printing money left and right. The circus is so much in town that you can walk around, stump your foot, fall face first in a pile of manure, and someone's going to give you a shovel and say, hey kid, I'll give you 10 an hour, start shoveling it. That's how much money was in town. Therefore, you could buy anything. And for those that are new to the platform, it's very easy for someone to say that today. But you can take a look at this platform and see that we were saying it back then. In fact, we wrote a post April 2020 that said, I've only been alive for 35 years, but in my 35 years, this is the single best time you can ever buy stocks in the market. Don't believe me? Go on to RHINO Wealth, our Facebook group, and see it, right? And you can see the videos that we've had recorded every single day ever since then. So I don't say this to like puff my chest out or to impress you, but it's to impress upon you, because we do have so many new people that those people should say, who am I speaking to? Who am I listening to? Why should I listen to you? I think that's why, right? Like at least I'm able to share that. And because we are privileged and because we, not pride goeth before the fall, but because we're satisfied with our record, we're satisfied with our performance because we know we will outwork anyone else. It's part of RHINO. It is impossible to outwork me. It's impossible. So you don't have to try. If you have the ability to work 25 hours a day, well, then maybe, because I don't have access to that additional hour, because I live in a world with 24 hours. So as a conduit of 100% work ethic with the requisite skill set and the requisite experience, that is RHINO. So I would put our platform up against anyone's, because I don't know more tools outside of insider information that would allow anyone to be successful. With that said, we always can get better. And because we know we can get better, because we know what we don't know, we guarantee to always get better. And that's a guarantee I can give. I can give you a guarantee that every day you're a participant here, you and I will get better than the day before, but we will never be as good as we will be tomorrow, right? That was a song back in the day. I love you more than yesterday, but not more than tomorrow. Anyway, and we do not promise that we have a good singing voice, because we don't. So anyway, getting back to the macro. So I saw a headline that Peloton was in the midst of rumors of people going to buy them out. Now, this is important. And also, let's go ahead and parlay on Amazon. So Amazon did really good Thursday reporting and continued to run all Friday. And on my way in, I heard, because I got in just a little bit before jumping on today, that Amazon was up again this morning. Great, cool. Don't really care. But what they cited was that this is the first time in 10 years that Amazon's buying its own stock. Now, that is important because the premise, the original macro point of view from a professional standpoint, if you're managing trillions of dollars, is where's the circus? There's only two places it could be. You have to start with two places. Is it in the public sector or is it in the private sector? That's step one. Public sector being government, private sector being corporations. Where's the best place to put your money? Where do you trust your money? Where are you going to get a return of your money? Where are you going to protect the purchasing power of your money? Now, the US government has 30 trillion in debt. If you liquidate the entire nation, I believe the GDP is 24, 25 trillion, which means our debt to GDP, meaning if everyone that owned a bond in the US called the US simultaneously and said, hey, listen, guys, sell everything because we want our money, which can never happen because there's a thing called an army, right? The US would say, all right, you now own all of US. We have to give you all of this, and we have to work for you because we actually owe you $6 trillion more. Now, in that environment, how can that entity, the US government, ever go ahead and pay a bond? Well, they can't, right? Like, they don't have money. But ever since Bretton Woods in, I think it was 67, Bretton Woods was 1944, where the US became the currency reserve of the globe. Back in 67, we got taken off the gold standard under Nixon. So we no longer had to go ahead and redeem gold for dollars because we printed so much money and we delinked from currency to gold. So from that point forward, the US is like, people in this world are going to let us do this. We could just print money, and they're like, all right, it's the US. Guys, this is really cool. Let's not quite a control with it, but like, print some more money. And if you take a look at the inflation rate since 1970, it's gone up every year. In fact, if you know someone old enough that's been alive in 1965, those are the people that say, when I was your age, a movie was 5 cents. And they're right, because they lived in an honest world where money was something that was real, it was tangible. They can go ahead and redeem the money for the gold. Now, there are a lot of proponents of the gold standard, and I'm not one of them. And not because I believe that the US or any country for that matter just prints money left and right, but because gold is a finite asset. And people say, well, duh, Anthony, that's why we like it. Well, population is not finite. Therefore, to go ahead and allow the money supply to grow with population, you'd have to constantly bring in new gold, which means because you can't do that, you can't just bring in free gold because gold has a value, hence the whole purpose of the linking, then you're constantly in a deflationary environment because the more population means the higher demand for a less supply of goods, being dollars. Therefore, something that's worth $10 today is going to be worth $12 tomorrow. Sounds great, but your income is going to go down as well, and everything goes down till eventually you take this to the outcome, the ending, and nobody has any money, and we're splitting dollars up and paying for things in pennies, right? It's just a little un-American. The Super Bowl likes high scores. Baseball loves the home run. We are a nation and we are a people that do not like low-scoring things. Otherwise, we would have soccer. We do not like soccer. We do not like green eggs and ham. We do not like them Sam I am, right? We love football. Oh my God, Patrick Mahomes threw another touchdown, another touchdown, another touchdown. The best game ever. Barry Bonds, you see all those home runs? Not like, oh my God, guys, did you see we won 1-0 in over 90 minutes? And there were 7 additional minutes, but we still won. Now, I don't downplay that. In fact, I remember when the US was in the World Cup, I think it was like 10 years ago, and we were great. Our goalie was phenomenal, but it's not something that this nation invests in, and hence we're not in the World Cup coming up, so I don't really have an interest in soccer, right? That being said, we are able to say, okay, the government or corporations. Now, you can make this argument in perpetuity. Basically, you could say, well, Ant, if you're going to go by that line of thinking, you should have owned corporations ever since 1970. Well, if you've ever seen a stock chart since 1970, you would know that probably was a good idea. It's gone straight up. But if you were going to make that decision on a more granular level, someone gives you money, what do you do with it? Now is not the time to put it into corporations, because how does the government go ahead and pay that debt? They have a thing called monetary easing, right? So they allow the Fed Reserve to buy bonds from the Treasury. The Treasury goes ahead and says, hey, listen, we're the government, we want money, we need to borrow money, right? And no one in their right mind would ever lend the government money because they can't pay it back. So the Fed Reserve says, oh, guys, don't worry, we'll lend it to you because we're just really nice people like that. And the government says, oh, Federal Reserve, thank you so much. You guys are super kind. Thank you. Do you think the Federal Reserve goes to the Treasury with like a suitcase of money? No, they go like this. The money's been wired over. And the Treasury says, oh, thank you, God. Woof, the money's in our account. How did they wire that money over? Because the Federal Reserve isn't actually a bank. Like you don't go, like don't bank at the Federal Reserve. You don't go to the Federal Reserve and say, hey, listen, where's a teller? I'd like to take my money out. It's not. In fact, the Federal Reserve used to be called the first bank of the US until they were banned. And then they were called the second bank of the US until they were banned. And then they're like, we need a better marketing department. How about the Federal Reserve? That sounds great. And that's who they are today. They're a private bank owned by private shareholders. That just happens to be in the US, but the US is allowed to go ahead and select the chairman of the Federal Reserve. So it's like they have oversight, but not really. But that's a story for another day. That has nothing to do with today. It's just a little history, and you should know the person you're speaking to has an appreciation for history, right? Cool. So the Federal Reserve does this thing called monetary easing. They go ahead and print the money out of thin air. Poof. And then they send it to the Treasury. Now that's never inflationary because the Federal Reserve sends it. So the Federal Reserve goes ahead and buys the bonds. And they don't actually even buy them all. In fact, all the banks are in this too, because the Federal Reserve has a thing called the discount window. That's where the Fed funds rate is. That's the rate that the banks can borrow from the Federal Reserve. And you might say, Anthony, now banks are borrowing from the Federal Reserve. I thought they didn't have any money. They still don't, but they lend money because they make money out of thin air. So the banks and the idea is if the banks are borrowing, they have to repay it. Therefore, it's not new money. It's just elasticizing the money supply to go ahead and smooth out the curvatures of a volatile economy. Well, it's not new money. The bank's borrowing it. They pay it back. In fact, they pay with interest. So if anything, we're taking money out of the economy. Well, when you have a good marketing department, that sounds great. That sounds like it makes a whole bunch of sense. When you don't, when you have like a brain, you realize, wait a second. If I could keep borrowing, then I'm never really returning the money, which means if I could borrow an infinite amount because you print the money and I could borrow in repetitivity infinitely, then what are we doing here, guys? Anyway, so the banks say, okay, listen, we're the banks, we're pretty cool. And we lend out to small business, right? Like small business relies on us. We're the banks. So we borrow from the Federal Reserve too. Like, why not? They're just giving it away. So the banks go ahead and borrow at 0%, which is where the rates are today. So if you're allowed to borrow infinite amount of money at 0%, what is that called? Am I like losing my mind here? Is that just not like printing money out of thin air? But okay. So now the banks borrow this money. What do they do with it? Well, there's a little agreement. And again, you could say, well, Ant, now you're going off the reservation because you don't really know this agreement exists. And I don't need to know it. I can't hear the barkless dog. For those that know what the reference is from Sherlock Holmes, where he was this amazing detective. He goes ahead and detects stuff. And they say, well, there was a robber. He was a neighbor. He came into the house. And they go, well, did you hear the dog bark? No, I didn't hear the dog bark. And Sherlock goes, well, if the neighbor was the robber, he broke into the house, how come the dog didn't bark? And it's not that I can go ahead and see what you're doing, but I can see the absence of what should be there for your story to be correct, right? So I don't know that they make this agreement because they don't invite Anthony to it. But I can tell you that ever since this has been going on, there's been no inflation. Anthony, there's been inflation. We'll get to that. But this has been going on for like years, right? So the bank goes ahead and borrows the money, and then they take that money, and then they go ahead and buy the bonds from the government. So the government always sells their bonds. The government always brings in money. And everyone along the way participates and makes their cut, their interest rates, right? But the agreement is don't ever put that into the actual economy, because if you put it into the economy, well, then you get inflation, because now we're increasing the money supply versus the goods and services. And if you put it in the economy during a pandemic where the supply chains are cut down and the supply is down, and now the goods and services are down, and now you're increasing the money supply, now you have inflation because you have all this money chasing less goods than existed a year ago. Hence, we have 7% inflation today. So where are we going with this, Ann? Well, now the Federal Reserve is coming out and saying, oh man, we really effed this one up. We have to go ahead and combat inflation. We have to. So we're going to go ahead and raise rates. Not today. We're going to raise them in March. But you better believe me, we're going to raise it in March. Because inflation, it's too crazy. Okay, now let's talk about that. If the Federal Reserve were to raise rate, what happens to bond prices? Now, for those that need a bit of a tutorial, and that's not a bad thing, right? We're all learning together. Bond prices and bond interest rates are inverse. So if I have a bond today that offers 1% and then tomorrow a new bond comes out that offers 1.25%, what happens to the value of my bond? It goes down because now it's worth less than that bond. And bonds are always priced at par, at 100. That's how bonds are priced. So if that bond is 100, mine can't be 100 anymore. It has to go down in value because anybody with two thoughts in their brain would say, I'd rather buy a bond that yields me 1.25% than one that yields me 1%. Okay. Now, if you go ahead and issue a bond with a higher rate, what's your repayment look like? It's higher, right? So if I'm issuing you a bond to lend me money at 1%, and now I issue a bond for at 1.25%, what does that mean as it pertains to what my repayment is? I now have to pay you 0.25% more, right? Because I'm borrowing money from you at 1.25% rather than 1%. So let me get this straight. So if I issue bonds at a higher rate, I'm raising interest costs on myself. And while doing so, I'm now devaluing the holdings of everyone that owns a bond. So those people that own those bonds are not very happy because I'm telling them all the bonds you own are going to go down in value. You know, I don't really care. I got to fight this thing called inflation. Okay, so let's go back to the macro, the circus. This nation owes 30 trillion in debt, which means there's 30 trillion worth of bonds out there. The interest rate is currently 0 at the Fed funds, which means the interest rate on our repayment of debt is as low as it possibly could be. In fact, the 10-year got down to 0.3% in March 2020. Now with the Fed saying they're going to raise rates, the 10-year is now at 1.92. That's an increase of 6-fold. The interest expense of this nation has gone up 6 times. It's 6 times greater than it was in March 2020. So what does that mean? Well, all of the money that could have gone to healthcare or schooling or you name the platform or the program or whatever is now going to paying our bondholders in like China, right? Okay. But that's the economy, right? We were like in a pandemic. It was March 2020. Everyone thought they were going to die. Like, I get it. And you can't really compare. That's an extra, Anthony, that's a once in a century thing. The last time was a Spanish flu in 1918. And I know that because I could, I watched CNN, right? So like, I get that. But now we're talking about actually raising it on ourselves. Okay. So let me ask you a question. Do you think that this government, that this nation is going to raise rates on itself to go ahead and pay a higher interest expense out of the money that it currently has? Do you think this nation is going to say, hey guys, listen, we already paid 2% on 30 trillion, but we are fighting this thing called inflation, so we're gonna raise rates on ourselves, and we're gonna pay 3% on that because that's real money, and now during a Democratic year and elections and stuff, now we can't even pay your Social Security because we have to go ahead and give it to China or something else, right? Now you might say, well, Ant, that's kind of like the economy, right? Like inflation goes up, they have to raise rates. Back in 1980s, Paul Volcker did this. Like this is known, like this happens. People understand this. I agree. I think that's a cycle. Like I'm not disagreeing with that. I think that's very astute. And I think anyone that manages real money understands these cycles and they position themselves accordingly. That's fine. Anthony, I hear a but. Yeah, a Becky's got back butt, like a really big, my anaconda don't want none, right? Like that, unless you got buns, son. Like that butt is right in front of us because this nation owes $30 trillion. This nation has made handshake deals all over the place saying they weren't going to raise rates. Now, I don't know that to be true, but I know that if I lent money to this nation at 0%, I would say, okay, well, it can't go lower than 0. So I need to have some assurances that you're not going to jack rates up, because if I'm lending you money and then you go ahead and demolish all the money that I lent you, so I lend you $100 and now it's only worth 90, I don't want that. I don't want to give you money if I know you're just going to give it a haircut. My bank account doesn't need a haircut, right? Okay. So that 30 trillion in debt equals 30 trillion worth of bondholders. Do you know what happens to 30 trillion worth of bondholders that all at the same time see their accounts go down in value? And not only do they see them go down in value, but they're being told they're going to continue going down in value. I'd imagine they get pretty pissed, right? I imagine they'd be so mad that they say, you know what? F you, I'm selling this right now. Now, if you sell an asset, what happens to the price? It goes down, right? Because people that own it at this price say, I do not want to own it at this price, so I'm going to sell it, which means the next person that buys it at a lower price than the person selling it, because if they were buying it at the same price, the person wouldn't sell it because they wouldn't need to, because the asset wouldn't go down, right? Okay, so if you sell something, it goes down. We know that. Okay, cool. Now, bond prices and yields are inverse. Okay, so if bond prices go down, what happens to yield? It goes up. Okay. If you owe 30 trillion worth of bonds, would you raise rates knowing you're not only going to raise rates on yourself, but you're going to cause a mass exodus of the 30 trillion that own the bonds, and their mass exodus is going to raise the rates even higher because they're selling what you currently have. Therefore, you have to go ahead and pay a higher expense than you can even control because you don't know when they stop selling. That yield could spike to 10, 15, 20%. Do you know at 12%, this nation is net zero? That the 3.5 trillion worth of tax receipts this nation brings in at 30 trillion, if that interest rate goes to 12%, there is no money in this nation for anything. You cannot even pay a single postal worker. All of that money goes to people that own the bonds, like China, Russia, whomever. Do you think the people of this nation would say, hey, you know what, guys? I know those politicians, they had it good in their heart when they printed all this money, and it was Republicans, it was Democrats, it was everyone. But Nancy Pelosi, who's worth like 100 million, and the Fed Reserve, who like trade stocks for themselves, they get a bad rap. This could have happened to anyone. In fact, I'm okay not having a single dollar for anything. I'm okay with the park not being open. I'm okay with police officers not being paid. I'm okay with my retirement never coming through because I believe that the politicians of this nation really tried their hardest. And I get that they live in these gated communities and they go ahead and receive $400,000 a year, and Fauci gets $450,000 a year, and they have these retirements. And I get that. They're the elite. They should get all of that. I can never do what they do. I deserve none of it. Therefore, I'm just going to sit here and die. I don't think that happens. In fact, I think if it ever got to that point, there'd be a real problem. Like people would go cuckoo for Cocoa Puffs. That's where people go with the pitchforks, right? So you then ask yourself, okay, so the Federal Reserve can't do that, right? Like, let's not make that mistake. So what do they do in lieu of that? What is the coward way of doing this? All right, guys, I'm going to raise rates. I'm doing it. Don't call my bluff. I'm going to do it. And in doing so, you go ahead and crash the stock market because all the really, really exciting companies, like all the tech companies, they're not profitable. In fact, their valuations are so high, but they're not profitable. And that's not a bad thing. Tech is one of those things that has a long duration because you have to build the tech, you have to build the software, you have to build the customer base, you have to test. But you can then say, I don't think Amazon was profitable till like a couple of years ago, but we would never say Amazon was a bad idea, right? So you have investors that invest in these companies. These companies have to continually borrow money so that they could continually grow the company, right? And tech is an automatable business. So once you grow it, cool, you're good. Well, if you have to continue borrowing money, then you're very susceptible to the borrowing cost. So if rates are going to increase in the future for as far as the eye can see, guess what happens to tech companies? Boom! Because they have to borrow at that expense. And if that happens, then what happens to hedge funds and pension funds and stock investors and all these people that own all this stock? What happens to their wealth? Boom, 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 boom. Like I do with my son, right? Like we box. Everyone loses money. So now all these people that had all of this money, these companies had these astronomical valuations, the stockholders, everyone had all this money, gets slaughtered. Okay, so what's that mean? Well, why else do we have inflation, right? Like increase in money supply. So let's go ahead and suck that money supply of the economy. In fact, let's go ahead and everyone that owns a stock, let's destroy them. So their wealth gets cut in half. Well, if you have half the money, we did pretty good about this money supply thing. All right, well, we still got to talk about like the goods and services. Well, that's supply chain. Supply chain has a natural rehabilitation process. You cannot create the supply chain overnight. But if you think that people work on a supply chain every day doesn't equal a supply chain that rehabilitates and just fixes itself, you're cuckoo for Cocoa Puffs. Meaning, if the supply chain works itself out and you simply just buy it time, at the same time, you destroy the money supply and you suck it out of the economy by punishing all those excessive speculators, those people that just buy and sell stock and they're making all this money, and those people get annihilated. And the last part, remember what inflation is. It's a rate of change year over year, quarter over quarter. Well, in 2020, you had inflation go really, really far down because the whole economy shut down, right? In 2021, you had the economy starting to reopen. So the inflation rate jumped up because prices that got slaughtered in 2020, like, did you ever get the phone call for like I did, I paid for it. I didn't go on it because then I got married and my wife said I wasn't allowed to go on a 5-day, 4-night Mayan vacation in Cancun at Riviera de Mayo by myself during spring break. I don't understand why she said that wasn't allowed, but she said I couldn't go. So I couldn't redeem it, but I bought it for $129.99. That was airfare included. I got a 5-day, 5-star vacation at Riviera Maya with wet t-shirt contest as far as the eye could see, first class plane rides for $129. Do you think that stayed $129 the next year? No, it went up because more people had confidence in the economy. Therefore, they started participating in buying stuff. So the inflation rate went up because the goods and services prices went up. Now, one could say, well, is that really inflation or is that just reopening? Is that like, prices came down due to, pandemic reasons? Well, unfortunately, the numbers don't dictate. You can't put an asterisk next to numbers. Data is data. You interpret data, but data is data. Okay, so let me get this straight. So in 2001, we're getting all worked up that prices went higher than it was in 2020. And the reopening completely destroyed the supply chain. And we did enhance unemployment and gave money to everyone. And the stock market went up every single day because you pumped money into it. And we're confused why there's inflation. Well, I can solve that real quick. Let's take the money out of the stock market, let the supply chain fix itself, and the year-over-year comparisons are naturally not going to be 7% anymore because last year wasn't a pandemic. Boom, inflation solved. Now, the only way you could do that is if you say that you're going to raise rates because you have to suck out the money supply. So if you do all of that, which I will argue has happened, then do you really need to do option one anymore? Do you really need to raise rates anymore? No, you don't. You solved it without raising rates because the big red button that says do not press is raising rates. If you raise rates, you will bankrupt this country. End of story. So if they raise rates, we're going to have a whole different conversation because if they raise rates, we are shorting every emerging market ever in the history of the world because they all gave debt in dollars. The dollar will spike up. It will be a nightmare. And I don't think there's a single Democratic politician that wants to have midterms in the middle of these bozos raising rates in the middle of a country that's going to be completely bankrupt, right? So I don't think they're going to do it. But if they do, I promise you, this will be the most profitable year you ever have because we know exactly what to do in that situation. And I will make every single one of you a millionaire so many times over because I will dance naked while this nation goes bankrupt. And that's not because I made the nation bankrupt. It's because I know what to do if they do something that dumb. So if we believe that they're like they maybe passed first grade, like they had a calculator like 2 + 2 doesn't equal baloney, then we know that they're not going to do that. Which means we know that the near-term pullback in stocks is mechanical. It's orchestrated. Which means we know that regardless of where we buy stocks, they're going to go up. Now, they might go down a little bit, but they're going to go up because the reason stocks are even where they are is because the money got sucked out of it. Now let's go back to the original question. If you were given the choice and you were a professional money manager, where do you want to put your money? Do you want to put it behind door number one and give it to the government in front of all that stuff we just said is going to happen at some point? At some point, that's going to happen. We don't think yet. But do you want to lend them money for 10 years? Or do you want to say, well, The corporate America has amazing balance sheets. They have more money than they know what to do with. Remember the pandemic? You remember how middle class and small business got wiped out and annihilated? Well, who do you think took their customers, right? Like these big companies are their own countries. They are, if Apple bought an island tomorrow, they would be a $3 trillion country. Now, I don't know how much every country's worth. Like I know America, China, Japan, UK, like I don't know. I think 3 trillion kind of puts you in the top 5, which means Apple could be a top 5 country tomorrow. Now, I'm not saying I'm buying Apple because I believe they're going to be a country, but I would say that I would put my money in Apple before I put it in the US. And that's an easy decision to make. Therefore, the money flow will go to corporate America, right? Do you see how we did that analyst? We were able to decide where the money goes. Now, once we decide where the money goes, now it's talking about timing and micro. Well, if I'm going to put the money over here because I think the circus is in town, do I want to buy peanut vendors? Do I want to buy manure shovelers? Or do I want to buy ticket vendors? I don't know. Let me go ahead and take a look at those individual businesses. Let me take a look at those business cycles. Let me take a look at those prices. And the reason I mention all of this is because as I was driving in, which was my story I started like 40 minutes ago, Peloton is in the midst of what people believe is a bidding war, that Apple, Nike, and Amazon all want to buy Peloton. Okay, what's Peloton? I'm not going to say stupid, because whatever, that's just me, right? It's a bike company. They have a product. When I was younger, it was Nordic Trail. Like they did not invent a bicycle that you can use at a gym. Like people did that. During the pandemic, everyone wanted a Peloton because you had the screen on it and it allowed you to be interactive, and you could be in a gym without being in a gym. You could be on the Peloton and ride your bike, and the screen in front of you is like, hey, Claire over there is doing good. Keep going. Kimberly, watch your butt. Oh my God, Mike, he's really coming for it. Like, and that's fun and that's great. And I think it's a good product. I really do. I've never been on it, but why wouldn't you? It sounds great, especially in the pandemic where gyms are closed. Sounds great. Okay. Well, their growth during this was astronomical. I think they acquired like 5 million, 10 million people. Subscribers. These people pay, what, $30, $40, $50 a month to be a subscriber to Peloton. Well, now the economy's opened up and no one needs to go ahead and sit there and ride a bicycle. They could go to a gym and go take a look at Kimberly's butt for themselves, or go take a look at Michael's muscles for themselves. They could smell their sweat like they're a wonderful Enrique Iglesias Latino man and just wants to sweat on them, right? Like you can do all this. You can leave your house and do that. So why do you need to do it home on a bike? You don't. So the stock has been down 85% since its highs during the pandemic. In fact, a couple of weeks ago, there was a note saying that they were canceling all manufacturing, that they slash prices. They can't manufacture anymore. They don't have anyone to sell it. Nobody wants to buy this thing because why would they? Okay, so it sounds terrible. Like, why would you want to buy that company? Well, the stock went down to $19 from 100, right? Like the stock represented as bad as you think it sounds. Okay, so if I was a company, where do I put my money, right? So I'm Apple, I have $200 billion, and I have all these platforms, right? Like I have an iPhone, I have this, I have that, cool, right? Whatever. If I'm Apple, can I make my own bike? I think I could. In fact, I probably could make a bike way better than Peloton can make. If I was Amazon, can I make a bike? If I was Nike, can I make a bike? So they're not buying the bike. Amazon has a subscription service. It's called Amazon Prime. Apple has a subscription service. It's called iTunes. Nike, I mean, can you have a better exercising company, right? Like, it's Nike. Do you think these companies are buying the bicycle, or they're buying the subscriber list? Or are they buying the data of the people who are voluntarily paying $50, $60 a month? I think that's what they're buying. Well, if that's the case, why are they buying it when they could just go ahead and build it themselves? Because corporate America has seen the stock prices come so far down, and because they have so much money on their balance sheet, that they have deemed it Microsoft's buying Activision. Facebook just bought 20 billion of their own stock. Amazon bought their own stock. Some other company just did another stock where they're going to buy their own stock. Nike and all these companies are saying, I'll go step in and buy Peloton right now. That $8 billion company, I know that I could buy that or their subscribers and their data for $8 billion today, when it's clearly worth so much more because we could bring it into our own ecosystem. So when you have companies not only buying their own stock, but they're buying the stock of their competitors, what does that tell you where the smartest people in the world want to put their money? Well, if I see someone who is the smartest person in the world, collectively, Amazon, Apple, Facebook, Nike, all doing the same thing, do I say, well, I'm Anthony and I'm smarter than them, I'm going to buy a government bond? No, that's 2 + 2 = Jello. That's not going to say stupid, right? So if we see all of this happening, we know to ourselves by observation, by calculation, by experience that we want to be in stocks. And we personally believe, like I'm going to tell you something right now, that I believe the US Dow Jones stock market by 2030 is over 60,000. It's now 34,000. So that means it's going to gain, in my opinion, if I just said that, about 4,000 a year. So if you believe the market's going to go up 4,000 points a year, which equals how much per month, right? Like 12 goes into 4, what is that, 300 points a month? Right? Something like that. Yeah, I think so. So if we believe the market's going to go up 300 to 400 points a month between now and 2030 on average, then why wouldn't you buy a stock, right? And if you were so astute to see that and you're running a corporation, why wouldn't you buy other people's stock? I have all this money. I don't know what to do with it. I'm not going to buy government bonds. I can't hire people. I already have the people I hired. There's not that much growth in the economy. People don't have jobs. I'll just buy other people's companies. That's what I'm going to do. So where do you want to be? So I want to own stocks. I think I want to own small companies though. Do I want to be, so we were talking about this Friday, what companies do you want to own? And we looked at the Russell 2000 and said it stopped going down. It looks like it's going up. And then we started doing some analysis. What is the Russell 2000? It's the 2,000 smallest companies that are the most economically sensitive in the whole country. Well, it's conceivable that if you're going to get bought out, if you're a company looking to buy other companies, where are you going to go first? If you're Apple, you're not going to go buy Amazon. You'll go and say, okay, what jewels got beat up in that index? Like, what's the really small ones? Let me see if I can get a couple of them first. Let me go pick the gold nuggets first, right? And then I'll do let me get the easy ones. So I want to be in the Russell 2000. Okay. So now it comes down to timing. I'm not just going to go buy it and it goes down, because guess what? You can be completely right. Like, our analysis is very sound. You can be sitting there right now like, well, duh, that kind of makes sense. But if you lose money on it, what's the point? You go to the bar, you lost all your money, you're drinking, and you're sitting next to someone saying, yeah, I had this idea. It was the right idea. I lost a bunch of money on it. And now I watched that, but I was right. I'm just broke because I lost all my money. That's where the other half of this comes in. You have to know, you have to have the disciplines, when to pick your spots, when to trade, what are you doing? Which is where RHINO comes in, right? Because we've built out the algorithms and the experience to go ahead and be able to share what we just shared with you, right? Like, I didn't read that somewhere. If you look behind you, which you can't, you see the things I need to do today, which is wildly overwhelming because there's 2 complete whiteboards with 3 different colors of things I need to do. But that's okay. That's not your problem. I'm here with you right now. You are one of the things. So I'm going to check this off and I'll have 1 check mark today. That's awesome. So we have to decide what we're going to buy, but what doesn't mean we're just going to jump in and buy it today. Because if we're able to do this analysis, someone else did too. So there are people that are jumping in and we'll be able to see the lines in the stocks. All right, it looks right here that the really, really smart people are saying, no matter what, we're going to buy here. But now it goes up. Well, these are the people that aren't so smart. They're just following those people. So they're going to sell it, but let's make sure it stays here and let's buy it there. So we're going to do our own analysis. But that's the background to our thesis. So that's how we catch fish. Now we got to go find a fish to catch. If that makes sense to everyone, let's go ahead and do some screen share. And by the way, we don't have 500 people in here, but we have a lot, just saying. So Don, thank you. Oh, so let me just see this, right? Only if the plan is to sink the US, from sunny Florida. Gunny, a name like Gunny sounds like you're in sunny Florida. It's a beautiful RHINO day in every way. Love you, and you rhymed. How do bond notes, Fed action relate to the euro? So Don, you ask a lot about the euro dollar interest rates, and I'm really embarrassed to say that I don't know. So all the analysis that I've given is, I guess, a macro. And then you'd have to go ahead and synthesize this down to the trading of these particular asset classes. So I don't know the participants and the functions of trading in those, because I'll tell you one thing about Wall Street. If you think it's simply this person buys this and sells this, it's not. This is then hedged by this, who has a desk over here, which then has a synthetic CDO over here, but they have options. So unless you're fully immersed in the structure of the trade, I can't make an analysis on it. So as it pertains to euro dollar, I can tell you that the euro dollar is going to go to zero. There's no reason for anyone to ever own the euro. You cannot have a currency that goes ahead and ties together an entire region, but does not tie together their debt. And that's how they got the euro through. Hey guys, no, everyone has their own debt. Don't worry, we're not going to touch the debt, but we're going to just tie it so we call the currency together. So then Spain goes ahead and completely does nothing except lose money. Germany does something really well. Spain needs to lower rates. Germany wants to raise rates because they want to protect the currency. And what do? Right? So you have given permission to the smaller countries to go ahead and run up daddy's credit card. And then you have the bigger countries like her daddy that are like, yo, you're 18, get out of the house already. So in the best case scenario, the euro dollar doesn't work. So in the worst case scenario, we think it completely falls apart. What that means to euro dollar interest rates, I don't know. But I do have a source in banking that says major banks will not take European bonds as collateral. They won't even give 10 cents on the dollar for it. So in the very highest levels, nobody respects the euro. And that's not to say that I think if you own the euro, you're unrespectable. I think your currency is highly flawed. I think it would behoove you to buy German bonds so that when your currency blows up, you at least get the German mark. Is that what it is? The Deutschmark, something like that, right? So do your own homework, but own the bonds in the big countries, because when everything blows up, you want their currency. That's my commentary. It's 10:57. Now, I knew I wasn't going to buy anything today, so it's okay that I ran that long, right? So let's see what's going on. Well, first, let's see where the market is, right? I see a lot of green. Okay. The Dow's up 80, the S&P's up 9, the Nasdaq's up 56, the Russell's up 9, the VIX is down. Now, first, when you go ahead and say that, everyone should say, Anthony, that's meaningless, because each one of these indexes have different baseline amounts. Therefore, the numbers I just cited to you, unless I give you the percentages, you can't compare them unless you're really good at math, which if you can go ahead and compare 81 Dow points to 10 S&P points, you should do a platform because I want to watch you, right? The Dow is up 0.23%, the S&P's up 0.22%, the Nasdaq's up 0.42%, and the Russell's up 0.48%. Now, if you remember the commentary we just gave, we said the Nasdaq is the one that got pummeled because everyone believes rates are going to go up, but we don't believe they're going to. So one would say that would be the environment, that would be the index that has been suppressed artificially. As you can see, it's higher than these two indexes. And if you recall, we said we want to own the Russell 2000, the smallest companies, because we believe they're the companies that are going to be purchased. Well, that's the Russell right here. They're 0.49%. So our commentary alone, and this, I guess, is what's cool about this platform. We knew where nothing is, but we're able to offer a commentary that's actually right in front of you, being told by the market as well. So we agree with the prices. Now, when we say we agree, that doesn't mean if we disagree, the prices change. The market is always right. Always, always, always. But if you and the market are both agreeing, that means you can trust the rest of your analysis to be at least in the right direction, right? Okay. Okay. All right, so let's take a look at stocks, right? Okay. Now, this is our super duper duper list, and we'll get to what that means in a second. But let's go ahead and actually compare some stuff. So let's take a look at the QQQs. And what you'll recall is the QQQs are ground zero. That's the index that went down 16% in January, which meant it was the index that had the most action, had the biggest names, had Facebook, had those names. So you want to at least be intelligent or well-versed in it, because you need to know what's going on with the main event to be able to predict the ancillary events, right? Okay. So what we see here is that, now we're going to delete that just because we want to have a fresh look. So over here, the market it looks like it's going sideways, right? I mean, it doesn't look like there's too much going on here. Okay. So it's going sideways. Let's take a look at the volume. The volume looks like it's going down. Now, a couple of things. Now, this is Friday volume. Friday is usually a lower volume day than the other days. Now it's winter time, so it's not as much of a thing. So we're going to take that and throw it out the window. Because, yeah, I get it was a Friday, but it was a Friday during February where the whole world is like doing stuff. So I imagine all the participants were here. And we say that because during the summer, the participants leave early on Fridays. They go to their Hamptons houses. So summer Friday volume is always lower. But winter Friday volume, if there's a need for it to be there, stays together. So we can say the volume's going down. Not by a lot, but also remember what happened here. Amazon had like its biggest day ever. So you can imagine there's a lot of volume that might have been Amazon related. And what can we say about the volatility? It's going down. So stocks are staying stagnant, right? Like they're going sideways. Volume's going down, volatility is going down. Now, what does that mean? Well, it tells me that the market's kind of getting lulled into a bit of complacency. There are not people running to go ahead and purchase this market. Otherwise, you would see it not only going up, but you'd see the volume going up. Oh, look, the market stopped going down. Look at this price. This is a buying opportunity. It used to be over here. Now it's over here. Everything's fine. Let me go buy. Which means you would see this going up and you would see the volume going up. But in fact, you don't see that. You see, all right, the market used to be here. This was a great time to buy. It bounced up. But did it bounce too high? Did I already miss out on my chance? I don't really want to do anything. I'm just gonna sit over here for a little. I'll see what happens and then I'll jump in. Let me just sit over here for a little bit. And you can see that because look, it's not going up, it's not going down, it's staying. The volume is going down, so people are leaving the market, and the volatility is going down because people that are still in the market probably own from in this area, but anyone could say, well, look how high this volume was. So most of these people sold. Look how high the volume was in this area versus the volume over here. So most of these people own the stocks from here. As you can see, the volume is going down. So there's not many new people buying here. The majority of these holders are these people. So these people are complacent. They want to see what happens. They're not acting volatilely anymore. They're like, okay, things are okay. But this volatility index isn't coming a lot down. In fact, it's kind of going down, but like it looks like it's going to smooth out. What this says to us is there's something still about to happen. We don't know what it is, but we know that this does not look like a market that gives me the confidence to say, okay, everyone's happy. Because remember what a market is, it's buyers and sellers. If I'm the only buyer, even if I'm right and everyone else is selling, I'm going to lose money. So I need to be cognizant of the participants in the market. And I do not see participants that are allowing me to feel confident that if I buy something, there's a underbelly of people that are like, hey, he bought it, I better too. Which means I'm going to sit back. I'm going to just see what happens, right? So that is the NASDAQ, which we believe is ground zero, right? But what does that allow us to do? So for those that are new, this is our super duper list. And what you can see is this is where, so our algorithm is again, we have a lot of new people today. So the algorithm that I've built, which is my own special sauce, like I'm not going to teach you how I make the sausage, but it's delicious. Once you put that sausage in your mouth, it sounds really sexual, right? The point is the sausage is delicious. And I don't need to share how it's made because it's, it's mine. I want to keep it. That being said, it's an exhaustion indicator. When these numbers start popping up, this means that 10 times in a row, something happened. Now, we're not going to share exactly what it is, but this thing happened 10 times in a row. Now, when this gets to 16, we start paying close attention because 16 allows us the opportunity that we can at least put half a position in and feel quite comfortable. Because what we can say is when that hits 20, 100% of the time we are correct. 100% of the time in our experiences, when it's a 20 red and green, we've made money. Therefore, if we start buying at 16 and God forbid it gets to a 20 and these red and greens hold, we still believe that we're not going to lose money, which allows us the confidence to pick our spots. So what does red and green mean? Red is a coiled spring indicator. The velocity of the velocity in selling equals a red line. when it's compared against a historical average over a 3-month trailing basis using simple moving averages. I know none of that even like it was Chinese, unless you're Chinese and then you're saying it was Japanese, unless you're Japanese and no Chinese and you're saying it's Spanish. The point is it's a language you don't know, and I get that. And that's fine. I understand it, which is fine. And I could back test it and show it. Oh my God, 10 red and green. I bet it's going to go up from here. Cool, right? Like I don't even need to look. 10, no red, no green. All right, it went up, but I would never have bought that, right? So what's green? Well, anything could go down. Going down doesn't mean it's good. Enron went down. Did you want to buy Enron? No, it went to zero. Green goes ahead and dictates money flow. So Lucid is this electric car company that I've never bought. I think I've heard of once or twice, but it's a 15 red and green. The market participants are stealthily getting into this. This is a name that's gotten beat up and it's the last one to rally. So I'm really interested in this stock. But because I'm not buying anything today, because I don't see a market that's conducive to me buying, I'm going to keep adding these to our list. So throughout today and definitely before our call tomorrow, I'm going to add more to this because conceivably there'll be more companies that fit the bill. And then when this gets to about like 10, 15, or 20, we then know there's enough opportunity out there for us to select the best opportunity and go ahead and take our shots. So I know from my personal experiences, I'd rather make 40% once a week or once every 2 weeks than make 10%, 10%, lose 30%, make 15%, down 20. I'm now 35. I don't have the heart to take that kind of stress in my life. I just don't. So I'd rather only buy things that go up. And if you agree with that and you like buying things that go up, then we're going to share research that's going to allow you to form your own personal point of view, your own opinion, and hopefully allow you to have a success equal to ours. Or if you're as good as some of the others in this group, you'll have a success better than ours because I know at least 3 people that kick my butt every single time I buy a stock because they use me as an indicator. Oh, Amp, what is 16? Watch this. Oh, Amp's buying more at 17. Now I'll buy it. And they always do better than them, right? So that's our presentation for today. I'm 7 minutes over. I promise you I will always keep it to an hour because I do value your time. And I do value that if you believe that this is a 10 to 11 platform, you might have things scheduled for 11. And it's not fair to you to miss those things or make a decision and miss what's going on here. So it's my word to you. We will always end at 11. And I understand I'm saying that at 11:07. So today is the day that will allow me to make that correct. So I'm going to stop the share. I see 2 things. Amy, I wonder if people bump into crypto instead. So actually, I think it was Amy that mentioned crypto to us or someone did. And we realized that crypto on a weekly basis was a 12 red and green. It's now a 13 red and green. I don't have a natural affinity for crypto. But I do kind of think the worst is behind us. If crypto ever got down to 30, I'd buy it. Obviously, that's easy to say at 43,000. If it got down to 40, I don't know if I would. So we will constantly monitor it. But crypto is telling us an optimistic story, but it's also a very thin market. So it's telling us, it's like when the children are all excited about something, it doesn't mean that what they're excited about is wrong, but it means they're easily excitable, right? So it's a tool, but not a rule. And Anthony, I sent an urgent question via email. Please check when you can. Don, do you need me to check it while we're on this call, or can I check it and just email you back? Email. Okay. Well, I'm going now anyway, so Don, I'm going to check that now. Guys, love you all. I'll see you tomorrow at 10 o'clock, and I'll catch you later. Bye.